go. 5, 4, 3.
Imagine if you gave me $100, and a year from now I gave you back $113, 13% return. That's what it was like for a lot of the 1980s with high interest rates, and what one could typically expect to get back when investing money into either a savings account or a CD. Times have certainly changed, and now that same $100 will probably only get you back about $101 or $102. The Federal Reserve has a large influence on why this is. The Federal Reserve, or the Fed, is the central bank of the United States and has been since 1913, when the Federal Reserve Act was signed into law. This is the Eccles Building in Washington, D.C., courtesy of the federalreserve.gov website, accessed June 29, 2016, and is the headquarters of the Federal Reserve System, which is the House of the Board of Governors, the 7 people that comprise the Federal Reserve Board, where they coordinate economic policy decisions with their staff. Summarized by the federalreserve.gov website, accessed June 29, 2016, the Fed's main purposes are to promote financial system stability, provide financial system security, provide services for the banking industry and U.S. government, and to promote consumer protection and economic development. In addition to the Eccles Building in Washington, D.C., the Federal Reserve System is comprised of 12 banks throughout the nation. Each of these 12 banks is responsible for overseeing the policies set forth by the Board of Governors in their respective districts, as depicted on this image by color and number. This map was provided by the federalreserve.gov website, accessed July 7, 2016. As I've been studying economics and pursuing my economics degree, I am learning more and more about the Federal Reserve and the important functions that it plays in the U.S. and global economy, and also the effects that these actions have on individuals. The Federal Reserve provides many services. Issuing currency, interest rates, and monetary policy impact most people's daily lives. The Federal Reserve issues currency, and it does this by ordering Federal Reserve notes, paper currency, from the Bureau of Engraving and Printing, which is an agency within the Department of the Treasury. The Fed then holds on to this money, and through extensive forecasting research, makes determinations as to how much money needs to go into circulation to achieve its economic objectives. According to Preston Martin and Lita Epstein in The Complete Idiot's Guide to the Federal Reserve, published in 2003, the Fed increases the money supply by buying securities, the Fed decreases the money supply by selling securities, and is largely in control of the money supply. So, for example, if the Fed buys securities from a commercial bank, it has increased the amount of reserves at this commercial bank, and now this commercial bank has more money available. With more money available, this allows for people in their everyday lives to borrow this money for mortgages, student loans, auto loans, credit cards, and business loans. And as I'm sure you're all aware, almost any time you borrow money, you do so with the intent to pay back this loan with interest. And that brings us to the next function of the Fed, interest rates. The Fed acts as the bank's bank, and one of its regulatory functions is to set reserve requirements. A reserve requirement is the minimum amount of money a bank must keep available. So, for example, if a bank has a reserve requirement of 10%, and let's say this bank has $100,000 worth of deposits at it, the bank is only required to keep $10,000 of that $100,000 available. Reserve requirements fluctuate per bank and are based upon the total amount of deposits at that bank. So, I mentioned interest rates. Interest rates are largely impacted by what is called the federal funds rate. The federal funds rate is the amount of interest a bank charges another bank on an overnight loan to ensure its reserve requirements are maintained. According to Stephen H. Axelrod in the Federal Reserve, What Everyone Needs to Know, published in 2013, the Fed uses the federal funds rate as one of its many tools to sustain the economy and so it can achieve its economic objectives. As depicted here by the Federal Reserve Bank of St. Louis, the graph was created in the website Access on July 7, 2016. The primary loan rate, which is the rate that almost all loans to businesses, consumers, and students is based upon, is closely related to the federal funds rate. Besides a few anomalies, these two rates almost mirror each other identically going back to about 1955. And as you can clearly see, when banks can borrow for less, all of us get to borrow for less as well. And this makes achieving certain dreams and goals, such as buying a house, a car, an education, starting or expanding a business, or making a substantial purchase on a credit card more realistic and obtainable. Issuing currency and interest rates are two Fed functions, and these two functions comprise some of the actions of the Fed's monetary policy. Monetary policy, as defined by McConnell, Brew, and Flynn in Macroeconomics Problems, Policies, and Procedures, published in 2015, is a central bank's changing of the money supply to influence interest rates and to help stimulate economic activity, provide price level stability, full employment, and economic growth. When the Federal Reserve wants to increase economic activity, it buys securities to increase the money supply and lowers interest rates to encourage borrowing and lending. When there is high unemployment and people are having a difficult time finding jobs, the Fed provides these actions in a hope to spark off more activity so people can go back to work and so people can borrow for lower rates of interest. However, the negative side of this is that money held in bank accounts earns little to no interest. On the other hand, when there is too much inflation, the Fed sells securities to pull money out of circulation and increases interest rates to discourage lending in an effort to stabilize inflation. The negative sides of this are that obtaining loans can become rather difficult, and if you do obtain a loan, it will be at a higher rate of interest. But the positive side is money you keep in a bank account will earn a higher rate of interest. While these barely scratch the surface of the complexities of what the Fed is and does, issuing currency, interest rates, and monetary policy are key functions of the Federal Reserve, and they affect all of our daily lives. The Fed increases and decreases currency and increases and decreases interest rates to control monetary policy in an effort to keep the economy strong, and so all of us can prosper from affordable loans, so we can conduct business at fair prices and for ample employment opportunities. Since the Great Recession, the Fed has kept interest rates low in an effort to stimulate economic growth and activity. The negative side of this is money we keep in bank accounts does not earn much interest, but we can all benefit and prosper from good job and employment opportunities.